value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca, Canada's authority on home ownership. Welcome back to the show, Ross.
And thanks for having me back on, Jim.
Ross, we have a question from a listener. Ivan asks, I've been looking to buy a home now for 3 years. Prices continue to go up. When will I be able to see price discounts?
When will you be able to see price discounts? Okay, so we see price discounts right now. So I understand that, Ivan, that you can't see the price discounts. But when you're looking at the real estate sales on a comparable house basis, that's when you see the price discounts arrive. What you're not going to see is in the real estate stats, the price discount that is being recorded now, or the one that's going to be really recorded here as we move through the fall. So what you've got right now across Canada is the end of the sales chain taking place. So there were sales that were in the queue pre-lockdown that subsequently had to occur June, July, August, and you may even see some in September. The first sign that those sales have all been taken out of the sales chain will be a decrease in the average selling price. So that will be the first indicator for you to see, Ivan, of house price change. There's a possibility that in September, some of the real estate boards across Canada, so it depends on where you're located. August was a sacrificial housing market month, stat month, and then September was a beneficial month. So for the sake of the argument, if you go to Calgary, you probably will see that Calgary sales were flat in August year over year, but then you're going to see that Calgary sales in September are showing a positive gain in sales. This has got nothing to do with the market changing between August and September. It's just how the calendar rolls out and how the behavior of the local real estate agents are in terms of how they interact with their MLS reporting rules. So in other words, there's some real estate boards across Canada where you have 2 days to report a sale, and it's 2 business days. Some boards count a Saturday as a business day, other boards don't. Other real estate boards have 5 days to report a real estate sale. And then there's the interboarding of listings. So in other words, that's where a real estate agent from one real estate board posts their listing from their board on another real estate board, and then those reporting rules really mess up the year-over-year comparisons. This has generally happened in Ottawa and in the Greater Toronto area. So in the Greater Toronto area, it's where it's the worst, but you also got to remember that's where the most sales, the highest percentage of sales take place in the country. So this methodology difference between each of the real estate boards really messes everything up. So I'll tell you right now, just go to Calgary because that's the most reliable one, because the way that their reporting rules are, you get to see it quicker in real time. You don't have to compare it against other real estate boards, but you'll see probably their August sales, if I'm not mistaken, were basically flat. And I haven't looked in a few days, but I think you're going to see that their September sales have jumped up, which the real estate board will claim a jump in sales. So these are the reasons why the public doesn't see what's going on, and why even the members of the real estate boards themselves don't know what I'm saying right now, even though now it's going to make sense to them if they're listening. In Vancouver, for sake of the argument, as you know, you've got in British Columbia, you have geographical differences between real estate boards. In other words, a Vancouver listing is going to be put on the Greater Vancouver Real Estate Board's listing service, and a listing from the Fraser Valley is going to be on the Fraser Valley Real Estate Board. The two boards don't interconnect. They don't get reported twice, 3 times, 4 times, as they do in the province of Ontario, in the GTA. I think the biggest multiple reporting we've ever seen in the GTA was 6 times. One single listing, one home sold, is reported as selling 6 times. And that's just the way it was multi-boarded. One listing was placed on 4 different real estate boards. It was counted in 4 different months, the same listing, but on 4 different real estate boards. So that impacts the numbers with the Canadian Real Estate Association. So in terms of you seeing price discounts, Ivan, you've got to remember, you're always looking at the price metrics the real estate boards have. You're looking at the average selling price, they call the average selling price, or their benchmark prices, or their MLX HPI indexes. You may also be looking at the Terranet National Bank HPI. These metrics all are measuring exactly the same thing, which is the buying power of the buyer. It has nothing to do with the houses. It's why we can show you how in Canada, in April they reported a $488,000 average selling price, and then in August it was $586,000. This change took place without the actual homes themselves changing a penny in value.
Ross, if I can interject here, we've had Wolf Richter, who's our correspondent in San Francisco, pointed out in the U.S. right now, luxury car sales are up 25%. But that's luxury cars. Regular car sales, regular pickup sales are down tremendously because the average person can't afford to buy right now because they have insecure jobs. But if you're in the upper echelon, you can afford to buy a luxury vehicle, and is the same thing happening with homes. The people who haven't lost jobs usually are executives or have secured jobs. They're doctors or accountants. They can afford to buy the luxury items. They're not going to look at the lower end condos. So won't that affect the average price? Isn't that really what these average price rises reflect? They're buying a better quality home. They're not buying a more expensive home.
Exactly right. So he is recording. So Jim, we often, as you know, in the old episodes of the show, of this show, we have used the car example. So it sounds like this fella is quoting the car example in the States. If everybody starts buying Lexus, or they start buying the top-of-the-line Cadillac Escalade, which is $100,000, obviously the average selling price of that dealership is going to go up, even though the cost of the cars may have even dropped. Because what you also have to understand with real estate is that when you discount the price of a certain category of home, more buyers are able to acquire it. So if you can jump, instead of buying a townhouse, into a cheap detached home, then that cheap detached home, meaning a whole bunch of people, whole bunch of buyers, they see value there, they buy them. That drives the average price up. So what this fellow is saying, Jim, is what we've been saying here in the show for years now. Home prices do not change over 90 days, okay? You cannot show me anywhere in North America 3 periods, three different times in 3 different cities over the last 40 years where you can prove house prices changed in 90 days. The data does not exist. Why? Because prices don't change in 3 months. I don't care what your real estate board tells you. I don't care what your local realtors tell you. I don't care what the Bank of Canada tells you. I don't care what CMHC tells you. I am sitting here telling you that I can prove to a grade 3 student with our data that prices don't change in 3 months. Let's say, for the sake of the argument, as this guy's talking about in the United States, you sold your beater car before the lockdown happened, and now you didn't have a car, and you happen to have a good job. Well, your plan always was to buy a higher priced car when you got rid of your previous automobile. But when you got rid of your previous automobile, the lockdown happened, and you couldn't go out and shop for your next car. The second the doors are open, that's when you go out and buy it, and that skews the data. The reason why we said in the show so many times, Jim, never, ever, ever look at seasonally adjusted housing data of any sort. Never, ever look at seasonally adjusted mortgage data. Ever, ever. Never, ever be fooled by change in monthly house prices or year-over-year comparisons, because one year to the next is never comparable. In the 1970s, when my dad started selling real estate, my great-uncle told him that's how it worked. In the late 80s, when I started, my dad told me that's how it worked. Back in the old days, everybody knew how this worked. It's only now, since the year 2000, where all of the intelligence of the real estate community has evaporated somehow. I don't know if all the old guys, I guess most of the guys that my dad was selling with are no longer here. So, I mean, my dad's, at 83, he's an older guy. Those people are all gone. That understanding has been lost. But as this fellow you just talked about, Jim, about the cars down in the United States, that's exactly what's happening. You simply have the buyer mix at this particular moment in time are buying the more expensive homes. Now, this has had long-ranging consequences because this is how house price illusion works. This is how the public is fooled, has been conned. This is why CMHC believes the Canadian Real Estate Association. Even though the Canadian Real Estate Association cannot prove with data that house prices change in 3 months, in other words, in the history of organized real estate, they have never proved this once. Never once have they supplied the data to the public. But what does happen is you believe in these comparisons of month-over-month data because the cycle doesn't follow a calendar year. So the cycle is always off by a little bit, and it never repeats. And the cycle can be a short number of months. The cycle can be a long period of months. It's never the same. There's only one time in the last 40 years where we have ever measured a trading cycle that has happened on the exact same length of time twice. Only once. And that was only for one provincial market. So, Ivan, you're saying, when am I going to see? You need to do this, Ivan. You need to target a home that you're after. Let's say, for the sake of the argument, you're looking for a 3-bedroom, 2-story townhome with a 1-car garage that currently is worth $700,000, $800,000. Don't look at anything else on Realtor.ca for the next 3 months. Only look at that criteria: 3-bedroom, townhome, 1-car garage in the price category that you're looking at. Stay within $50,000. So go $700,000 to $750,000, $750,000 to $800,000. Only look in that price point, because it's only there that you'll be able to see if there's any change that's taking place. What I'll tell you is this: if you go to Realtor.ca every day and you're looking every day, hoping to see house prices drop, you're not going to see it, even though the prices are already dropping. In the great house price correction of the 1990s in Ontario, where families were losing 40%, houses were selling at 40% discounts of what they were at peak. The Canadian Real Estate Association historical data only showed a $10,000 drop ever took place. Now, 30 years later, when you look at all the charts, especially when you look at the Canada chart, it looks like there was no drop that ever took place. All you see is a straight line. That's because home buyers were still spending the same amount of money. It was the seller themselves who was the one that was taking the hit. But there was nowhere where that was recorded. It wasn't recorded anywhere. And here we are now in the 2020, and we're seeing house price decline. Well, the real estate board is claiming they had almost $100,000 increase between April and August on the national level in this country. The absurdity of these things is just incomprehensible. But Ivan, you need to target what you're looking for. You need to only look at that. You can't listen to anybody else, and you need to be on these sold sites where you can track that exact same property. Okay? Stay in that singular price point, and that's how you'll know when real price change is occurring.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Ross Kay. Ross, the Bank of Canada is using all the tools it has to fend off a depression. In terms of the housing market, do you see them winning or losing right now?
What I see is a group of economists at the Bank of Canada who are watching real estate brokers stoke the housing bubble in order to get their last commission dollars out of it while they can. That's what I see what's going on here, Jim. I see the Bank of Canada believing what the real estate brokers are saying. The Bank of Canada is under the false impression that the housing market is continuing. They are actually under this belief. Now, for whatever reason, they don't know how to look at real estate data and debunk what organized real estate is telling them. So while the real estate brokers are claiming house prices are up $100,000 since April, $488,000 to $586,000. They're stoking the housing bubble narrative even bigger. The Bank of Canada is listening to them and believing it. So they're taking monetary policy based on what they're hearing about the housing market. Because Canada's economy goes with the housing market. Now, I'm assuming Bank of Canada economists know this. They just are afraid to ever put it down in writing on paper for the public to see, because that would expose Paul Laws's 2013 appointment through his 2020 departure as for the fraudulent period of what it was. Fraudulent in our terms, Jim, is he didn't once tell the Canadian public what was going on in the housing market. He did not use his massive staff to simply question the Canadian Real Estate Association to prove what they were saying. He didn't do that once. So what can the Bank of Canada do? All they can do, Jim, is delay things, because they are now in the interest are suffering the consequences of the interest rate trap, which again we talked about in the show over a year ago. Housing markets rely on declining mortgage interest rates. There has been no period from 1982 through till today where the housing market in Canada has sustained a period of rising interest rates. There is no time where they have sustained a period of moderately level mortgage interest rates. Now, I have to qualify the term moderately level, Jim, because the bankers have played games with mortgage interest rates for the last 40 years. They do tweaks up and down as they're recording. We believe, okay, so we can only believe they know what we know, okay? We believe they're making these changes to interest rates because they're recording a small slowdown in the housing market. They see that small slowdown. They see that their profits for their shareholders are going to drop because their mortgage book is going to drop, and they'll drop the mortgage rates. Immediately upon the real estate market recording a little bit more activity, then they'll raise the rates. And they play this up and down game, as they have for 40 years. This is the game that they play. It's the reason why when the OSFI brought in the mortgage qualification rate, the OSFI and the Bank of Canada and CMHC were not prepared for the new games the banks were going to start playing, which was to leave the 5-year rate posted so that they could squeeze the spread out of their clients at renewal time. So the only reason they didn't understand banks were going to do that, I believe, is they didn't either A, they're clueless, or they didn't think the banks were this unethical. And I look at it the opposite way. Look, the banks are totally ethical. They are there to extract every single penny from you that they can, because that's the way their executives get a bonus. And in terms of the bank CEO presidents, we're talking millions of dollars of bonuses for every dollar they're able to extract from you. They are not here to be your friend, to be your trusted advisor, to do you a favor, give you the best rate, give you the best terms, offer the best advice. No, they're there to take money from you. That's their only job. For whatever reason, the Bank of Canada hasn't seen this. So when we look at it this way, in terms of the Bank of Canada saving Canada from this recession that we're in right now, the housing market has not recovered to where it was prior to the lockdown. Whatever the realtors tell you, we don't care. I'm saying this on the show because I know a year, 2 years from now, when the housing market is fully reacting and everything that we're reading today is fully being recorded in the real estate numbers, what I'm saying here can go back and fact check and see if it's true. We told buyers in 2015 not to buy into the Vancouver housing market. At the same time, we were telling sellers, hold off selling until the spring of 2016. That sounds like it doesn't even make sense to most people. It does to us, because we knew the exact same thing that's happening right now in Canada was happening in Vancouver in the spring of 2016, excuse me. You had the highest share of sales were going to the single detached class of homes, which creates the greatest house price illusion before a housing bubble pops. The Canadian housing bubble actually popped in November of 2016. It's just taken this long for everybody to realize what's going on. That the housing bubble popped, and then the OSFI had new rules that came in. So that delayed the fall. So in other words, what normally you would have seen in 2018, you weren't going to see until the summer of 2020 because they changed the rules of the game. Even though you changed the rules of the game, the outcome of the game is still going to be the same when it comes to housing, because the size of the market is so huge. We're talking a $6 trillion asset class. It takes a long time for those numbers to show up. But in the meantime, all of the people that are going out buying from the fall of 2019 right on through till today, believing the real estate brokers who are stoking the housing bubble, believing the Bank of Canada that we're going to keep interest rates low and we're going to stave off a depression. They're buying into this story. They're buying into this narrative. They're committing to a 25-year mortgage. It's unethical. It's wrong. The advice that they're giving now, if you go back and you were to test it in history from 1982 through till today, you'll find what they're telling you could never be reproduced. In other words, the theories that they're putting forward, when tested in a historical perspective, do not produce the results they're claiming the theory is going to produce. We believe that when you have a theory, you should be able to test it and vet it in a historical context for accuracy. Before we come out and make a statement on a housing market, on a factor that influences the housing market, how a change in a lever is going to affect the housing market, we go back throughout history and we make that change as we move along. And we see if the expected outcomes we're looking for actually would have happened. If they didn't, it means our theory is no good. It means we should keep our mouth shut, throw the theory away, or adjust the theory so it works throughout history. What we're hearing right now are simply nonsensical items about housing prices going up forever. That's impossible. Everybody knows it's impossible. That the Bank of Canada is going to be able to hold interest rates low, and that's going to allow the economy to extract itself. Well, when in history has that ever happened? When has the bank ever done this successfully before? When? Show us one single 2-year period in the last 60 years, I'll go back further than the standard 40 that we have, where your theory can be proven once, just one time. And what we know is their theories don't work.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia.
Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross Robert in Orangeville, Ontario asks, I'm wondering what Ross' thoughts are on the shared equity program CMHC is offering as it applies the last few months.
So now my story on the shared equity program is totally different than what it was when they brought the program up, because the trading cycle has moved forward. We are at a different phase in the trading cycle. So now the flawed policy of CMHC, which hurts you when you use the shared equity, now can actually hurt CMHC. In other words, you can utilize the shared equity program. Now, I need to qualify this. Not everybody can do this. Doesn't make sense for everybody. I'm just saying the program itself, as you're at this end phase of a trading cycle, is designed to work to the benefit of the family and not CMHC. So in other words, the government is not going to profit by stealing a portion of your gains by stroking you into buying a more expensive home through the shared equity program. What's happening now is CMHC is taking part of the risk. And here's why. If you look at the program, you are able to buy your way out of the program whenever you want. And when you buy yourself out of the program, at the time where CMH's share of the responsibility takes place. So let's just say, for the sake of the argument, you're in a 50-50 deal with CMHC. You put 5% down, CMHC put 5% down. Or you bought a brand new home. You put 10% down, CMHC put 10% down. Your house drops in value $40,000. Okay, there's a $40,000 equity shortfall. CMHC's on the hook for half of that. So if I can effectively buy CMHC out at 50 cents on the dollar to what they entered in their shared equity program with me, then I'm going to do it. And I'm simply going to wait, continue to own my home, as my intention was the very first day that I bought it, until the day I die. But what I've done is I have forced CMHC to take a loss on my equity because they didn't design the program to work with the trading cycle. So I wouldn't have used the shared equity program when I knew the price of my house was going to increase. But now that I know that the price of my house is going to decrease, then I'm going to utilize it at the early stages of if I'm buying, on the snow cap of the mountain. Okay, if I'm buying in that period, that's when I want to use the shared equity program, because I'm going to offset my risk to CMHC. In the other portion, CMHC was saying, hey, look, you guys are taking all the risk. We don't care. We're going to take your profit. Now the tables are reversed. It's CMHC who's going to take the risk, because you're able to extract yourself whenever you want from the program. They are going to do an appraisal at that time, and the equity loss will be shared. It is a shared equity loss. The smart person right now is staggering their deposit so they have enough money in reserve to buy out CMHC over the next couple of years. Because when the timing is right, if you've kept money aside and it's been earning interest in some manner or another, you kept it in a TFSA, it's not even taxed, there's no taxes on it. And you keep adding to it. In other words, whatever mortgage payment you would have been made, you keep adding to that. You make that payment instead into your TFSA or wherever you've saved that money. And you're building that reserve up. So you'll be in a position to buy out CMHC with cash. So this is a situation where the rules that are put in place to take advantage of you when the rule was created now work to your advantage for the unintended consequences of that rule. You have to understand, policymakers, government, CMHC, and economists, those people who are always consulted when these changes take place. They don't understand how a housing market works. They don't know the cyclicality of a housing market. They don't know how the trading cycle works. They don't know what drives a housing market forward. We do. Again, because if our theories can't be used in a historical context to provide accurate responses, then our theory is no good. We only talk about theories that work. When we hear the comments, Jim, so I'll leave Robert with this comment because he's in the GTA. When we hear these crazy comments, Josh Gordon, a UBC, a professor from some British Columbia University, had an article in the Globe and Mail saying that supply and demand, making comments about supply and demand. We're just shaking our head. What data is the guy looking at? Because the data set that we're looking at doesn't just show a close relationship between housing supply and prices. It shows a 100% relationship, right down to the dollar. The accuracy between supply changes, the way we measure supply, and the house prices, the way that we measure housing prices, is 100%. Because it has to be. This is what Robert needs to understand with the shared equity program when we're telling him that he may be in a situation where he can capitalize on the flawed program. This goes back to the Bank of Canada question earlier. The earlier question from Ivan about when we see house prices change. Okay? We know where prices are going to be because we're measuring supply and demand in a totally different way than what all the other economists are measuring it. All the housing analysts are measuring it. We measure supply and demand based on the behavioral patterns of buyers. Okay? If we have 50,000 new immigrants come into this country, we don't look at the 50,000 number. We look at the head of household numbers. We look at the income level that they're going to have. And then we have to adjust our demand numbers from that based on those responses. You can't just say 50,000 new immigrants are going to need 23,000 new homes. No, some will need housing. Some will need rental housing stock. Some may need ownership housing stock. Some may need home ownership housing stock 2 years from now, 3 years from now, 5 years from now, 7 years from now. The behavior is always the same. The only thing that changes is the infrastructure itself. So you have to change what levers you're measuring. So you got to say, this lever's pulled halfway down, this lever's moved halfway up. What change is that going to have in the housing market? These levers are precise. The impacts they have are precise, 100%. So I'll end the show with this today, Jim, for Robert in Orangeville about why shared equity. We will tell you 100% of the house price growth that has been recorded since 2000 is solely a result of supply. That supply change impacts the MLS house price pyramid. In other words, if you're not building houses that current homeowners want to buy, those homeowners are forced with staying in the resale housing market. They can't exit into the new homes market. When a buyer who has been normally, let's say you've got 20, let's say you take 100 buyers in a certain price point category. And we know historically 10% of those buyers are going to leave the resale market and they're going to buy a new home. Well, when those new homes are no longer available, that forces those buyers to reevaluate and stay in the resale market. What that means is the next trade-up, the purchase of the more expensive home, which normally would have recorded 80 buyers, in other words, 90 buyers, 10 left for the new homes market. Now you've got 91. If just one more buys. Okay? That one single extra purchase in the executive class home raises the average. The raise in the average gets reported by the organized real estate as a house price change. The house price illusion happens and people believe it. Listing prices rise and return. It's why it's a MLS house price pyramid scheme. I don't think Ponzi scheme is the right word to use. I think it's just literally a pyramid scheme describes it. A pyramid scheme that ends with the pyramid falling in the ground and regular Canadian families being left to pick up the pieces. 100% of all house price change has got nothing to do with foreign buyers. It's got nothing to do with money laundering. It's got nothing to do with leaving from COVID, work from home. It's got nothing from the hundreds of stories or items that have been claimed to have caused the housing bubble. It is one thing and one thing only. Lack of supply of housing to Canadian families. Nothing more, nothing less. If politicians choose frogs, butterflies, and turtles lifestyle over the lifestyles of Canadian families, these are the consequences that you have. It's why we go back, like we said earlier in the show. Theory doesn't matter. We need theory that can be tested, that can be proven true. You need to go through a thorough scientific method before you open your mouth about a housing market, as far as we're concerned. Because we know what happens when a housing bubble pops. We know that they're inevitable. We know that we're in one right now. It's been stoked by your real estate brokers in the middle of a pandemic, the middle of a lockdown. You've seen real estate brokers across this country claiming house prices rose when they weren't. Because, folks, if they could prove house prices rose, they can claim our money. All these people with the big sayings, all these people saying all these things, if what they were saying was true, why wouldn't they just claim the money? Because they can't. It's not true. That, Robert, is what you need to understand. The CMHC Shared Equity Program was a foolish thing for someone to participate in when it was first launched, and in many locations across Canada today, you'd be foolish if you didn't take advantage of it, with a proper strategy in place.
Ross, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.